It's certainly been an interesting quarter in politics, in markets and in economies again. I mean, I want to touch on the events of the 7th of July when Boris Johnson resigned, because I think it's important that we touch on the market impact. And it's not going to take very long, because the market impact of the recent political developments have been very small within the UK. You saw sterling impacted, very minor. And that is actually a slight positive for equity markets. So if sterling's slightly weaker, it means that the amount of overseas earnings coming into stock markets like the FTSE 100, which are predominantly where earnings are derived from overseas, is a small positive as well. So in a roundabout way, the recent developments have been relatively positive from an investment perspective. Clearly, we're in a bit of an unknown time now until we find the next leader of the Conservative Party and the Prime Minister, but it's really not impacting on markets. And I think that was an important point to make from the outset. Away from politics, it's been a quarter which has been dominated by, yet again, inflation. We've had the inflation readings out this morning, and we'll touch on that later. That's led to a policy response from central bankers and interest rates moving higher, and higher than people were expecting to do so maybe 3 or 4 months ago. Economic growth is starting to be impacted by that. And the question that we're getting asked more so than ever at the moment is, are we heading for recession? And we'll touch on that during the presentation today as well. And within the wider global world, we're seeing COVID rates still continue to pick up. The way that economies and countries deal with them are being dealt with differently. The exception at the moment is really China and their zero COVID strategy, which is weighing on economic growth. And obviously still going on is the sad events going on in the Ukraine as well, and that's impacting commodity markets and political developments with regard to the pipeline to the Nord Stream pipeline at the moment as well, is very much in the headlines. So there's a number of factors which have been really dominating the markets in the second quarter, and overall that's really weighed on investment markets and continued the theme from the first quarter of markets being relatively weak. And when I say markets, I mean both bonds and equities, and there's a tendency just to concentrate on the equity market. So that's what's happened. Today we're going to touch on what we think is going to happen in the future as well, and provide an outlook, and that's what the plan is. So I'm just going to start sharing the screen, and we can go through the presentation. So as I said, we'll give a quick economic update. We'll touch on inflation and interest rates, which is the dominant factor, the impact on major markets this year, and an outlook. So this is designed to highlight the struggles that central banks have got at the moment. We're in a world of higher inflation. And when you see higher inflation, you'd expect interest rates to move higher to be able to combat that and to bring down inflation and future inflation expectations. But on the flip side of that, central bankers also have a job to maintain stable economic growth within the economy as well. And inflation being high is starting to disable that. So it's a very challenging environment for central bankers at the moment. And it feels like the risks are quite equal on both sides at the moment. You've got high inflation, but you've got weakening economic growth. So it's definitely a challenging backdrop for central banks. In terms of economic growth, though, this chart or charts just highlights where we are and where we've been. So on the left-hand side, it highlights 4 major economies. You've got China in that orange line. It goes back to 2006. The official figures out of China are always subject to interpretation, but you can see how strong the Chinese economy has been for almost the last 15 years or so. You've got the US, which is behind that in that grey line, UK in blue, and in Europe in that purple line. The dotted segment towards the end of that chart highlight where the expectations is that we move to in the future. And you can see there that there is a small downtick in the line more recently, and that's a reflection of the inflation and the economic growth impact that we're going through. And just to move to the right-hand side of this chart, this shows all the major nations again, and shows what the predictions were for economic growth in these countries at the beginning of the year, which are the dark blue bars, and where we are today, this is at the end of June, in those green bars. So I think the first thing to say is economic growth has been revised lower across all major nations this year. There's very few exceptions, and that's a reflection of the fact that you are seeing this higher inflation, and it's almost a tax on growth. You've seen the war in Ukraine, which has disrupted commodity prices and global supply chains, and also seen two nations impacted by economic growth within that as well. And then China and their COVID strategy has impacted the country as well so far this year, and that's weighed on economic growth both in China but also globally, and will have an impact on global supply chains as well. Now, I just want to focus in on the UK though, and we've got a bit more information on this later in terms of do we see a recession coming or not. So the UK coming into this year was forecast to grow by just under 5%. And that was on the basis that we're still seeing the COVID bounce back coming through. Last year, we didn't have a full year of that because restrictions were gradually eased in the first half of the year. And 2022 was seen as a year where that stock continues to come through. So that's why economic growth was expected to be high this year. That has been revised down lower, and the forecast by, this is a panel of different economists, is for UK economic growth this year to be 3.5%. Now, to me, that still feels a little bit high, but just to put that 3.5% number in context, the UK economy on average in good times grows at 2%. So the current expectation within the market is that the UK economy is going to continue to grow faster than it would do in a normal year, because you've still got this COVID bounce back coming through. Now, it's not just the UK where you're seeing that situation, it's across the globe as well, because restrictions were all eased, very similar. The UK was slightly ahead of different economies. The US, for example, is still expected to grow by 2.5% this year, which is still pretty strong growth for a country the size of America. And despite the fact that China has had this zero COVID strategy and restrictions have been in place in major cities in China, that is not lost consumption, that is just delayed consumption. And we've seen this within other global nations as well. When you have restrictions, it really impacts you in that environment, and economic growth does get impacted. But people don't want to cancel their habits, they're just delayed. And when you can and restrictions are lifted, people scramble back to their old lives to enjoy themselves, which means that you get a subsequent strong bounce back in the economic recovery as well. So despite the fact this year has been a very challenging year for China, the forecasts are that it could be a very strong second half to the year, because of the fact that you've got that bounce back in terms of restrictions being eased. But also China have announced that they're going to do more infrastructure and investment to try and stimulate the economy as well. So despite the fact that we've had a challenging start, the second half of the year could be a completely different picture. Now, the joys of putting these slides together is they're quickly out of date, and we had the CPI data out for the UK today. For those of you that haven't seen it yet, the CPI came in at 9.4% this morning, which is the highest since 1982, so the highest for 40 years in terms of inflation within the UK. RPI, retail price inflation, came just under 12%. It was 11.8%. That was announced this morning as well. So there's definitely a significant amount of inflation which is weighing on consumers at the moment, and that is the main headwind that we see presenting to the UK and European economy in the second half of the year. Now, I just want to touch on where those inflationary forces are coming from. This chart takes this CPI figure and goes all the way back to 2011. So you've got 10 years of data. The reason we go back to 2011 is because that was the last time the UK economy was coming out of recession. And whenever economies coming out of recession, you do see demand come back very strongly, and supply is often slow to respond and come back. And that leads to inflation because you've got demand, which is higher than the supply. And that's exactly what happened in 2011. And people don't really remember it because it's fleeting, but inflation in the UK was around 5% back then. Now, when we were coming into this year, we expected UK inflation to probably hit a very similar level because exactly the same situation was unfolding again. You had demand coming through and you had supply not able to respond, and supply has been weaker this time around because of the fact that you've had COVID restrictions in place, which has impacted global supply chains. So we were expecting inflation to be high this year, but it's been supercharged by the commodity impact that's come from Russia's invasion of the Ukraine. That has certainly added probably 50% more inflation this year. So if 9.4%, about half of the inflation that we're feeling right now, is a reflection of the fact that oil prices are higher and it's costing a lot more to fill up our cars, but also because we are reliant on natural gas. And in the UK, we don't import from Russia, but we are impacted by natural gas prices in general. That's clearly had an impact in terms of the energy bills that we're feeling now, but also the energy bills that we're going to be feeling in October. Now, I think there's a tendency for people to think the UK is special and the UK is different. I want to get rid of that myth. Because in this inflationary environment, the UK isn't special and the UK isn't different. US inflation is currently running at 9.1% consumer price inflation, so very similar to the UK. EU inflation is running at 8.6%. And I suppose the key differences to those nations compared to the UK is their energy prices are constantly changing, they're fluid. Whereas in the UK, we have this semi-annual change which comes through for the off-gen prices. So the inflationary impacts are going to be slightly different in the UK than they are compared to in Europe and the US. So that's where we're going. That's where we've been. Sorry, this is some expectations of where we're going. So this on the left-hand side just shows UK, Europe, and the US. And just to highlight that these inflationary pressures, as I mentioned, are being felt globally at the moment. But you can really see the impact that the off-gen price has on the UK expectations compared to other nations. Inflation is probably peaked in the US and Europe now, and you can see that that's starting to come down. And that's crucial for central banks, and we'll touch on that later. But within the UK, inflation is likely to continue to pick up, and the autumn is probably going to be the highest figure. The Bank of England have actually said that inflation could surpass 10%. So we're at 9.4. We could see another 1% or so in terms of more inflation to come. Whereas the US and Europe look like they've probably peaked because of the way that their energy price mechanisms work. But look how quickly that inflation drops off, or is expected to drop off according to these estimates. And only have to fast forward a year's time for inflation, if this is correct, getting back very close to the Bank of England and central banks' target rates of around 2% or so, which is quite astonishing, really. The real risk at the moment is whether you start to see wage inflation coming through. Because if you see wage inflation coming through, then that means that people feel wealthier. It means they go out and consume more goods. And that means that you continue this inflationary spiral. And that's what central banks are very keen to avoid at the moment. And that's why, despite the fact that you can't control commodity prices, interest rates are still moving higher. So the expectation is that inflation is going to start to fall, and that's crucial because that takes pressure off central banks. And the volatility, and most of the volatility seen this year, has been driven by what central bankers have been doing. And this was highlighted again in June when the Federal Reserve surprised the market and increased interest rates in the US by 0.75%. That just means that it's becoming slightly tighter for money lending within the US, which weighs on economic growth. Now, I don't want to present an overly pessimistic picture at all, because there's plenty of positives to be seen at the moment. We've gone into this higher inflationary environment with consumers probably the wealthiest they've been for a very long period of time, because of the fact that we've paid down debt. Asset prices like our houses have increased in value over the last few years after COVID. And the employment picture within the UK is very strong as well, and globally. And on the right-hand chart here, you can just see the amount of job vacancies which were being advertised in the US, Germany, and the UK. And you can see that we're at a 20-year high in all markets in terms of vacancies. There's a lot of pent-up demand, and as well as this, it's become, we'll touch on it in a minute, unemployment is at record lows. So there's definite positives to be taken from this. So where are we in terms of interest rates? Well, we've seen interest rates increase over the last few months, since December. UK interest rates are now at 1.25%. There's chatter this morning within investment markets that you could see a 0.5% increase at the next Bank of England meeting. I think it's very likely you'll see interest rates go again the next meeting. Whether that's 0.25 or 0.5, we'll find out in the coming month. But interest rates are going to continue to move higher. Now, when we talk about interest rates going higher, though, we still expect interest rates to probably peak at maybe 2.5% in the UK, which doesn't really sound like a big number compared to where we have been in the past. It's the highest since the financial crisis in 2008. But if we look back into history, and I mentioned earlier that inflation is now at the highs of 1982, interest rates back then were at 12% or over 12%. So the environment that we're in today is still significantly different, despite the fact that we have the same inflationary figure today as we did 40 years ago. And one of the principal reasons for that is because we are in a highly indebted environment. On the left-hand chart just shows the government debt levels of major nations. The more developed nations are in the blue and emerging markets are in the green. You can see the range that countries have operated within, which is the size of the bar, and the diamond represents where we are today. So within the UK's case, we're just around 100% of debt to GDP, which is the upper end of expectations. So if interest rates were to continue to move higher and higher, then it just increases the debt servicing costs and the interest payments that we have to pay on increasing interest rates. And the Bank of England are very aware of that. And the UK economy is probably the most sensitive it's ever been to an increase in interest rates because of the fact that we have so much debt. The right-hand chart just shows how this debt has been accumulated over the last 20 odd years. The blue line is the UK, the grey line is the US, and the purple line is Europe. You can see that there's been two real periods where debt levels have increased significantly. You've got the financial crisis, which was a huge jump in GDP. You know, if you only have to go back 25 years, when UK GDP, debt to GDP, sorry, was at 40%. It's now, as you can see here, just gone over 100%. So debt has increased significantly there in the financial crisis, and then again in COVID, because we were looking to stimulate and support the economy through furlough scheme, through loan schemes, to eat out to help out, VAT cuts, etc., which has led to a balloon in the amount of debt that we have. Now, just taking a step back, unemployment rate is, as I said, very, very low, and you can barely see the impact of COVID within the unemployment rate and how quickly the employment market was to bounce back. Now, I got asked a question yesterday by a client. Well, you know, is this a fair measure to look at nowadays? Because of the fact that over the last 2 years, you've seen the employment pool reduce significantly, and that's definitely been the case. You've seen the employment number of people employed in the UK reduce over the last few years, and that's a function of people that have basically had enough. They've had enough of working, they've had enough of the constant volatility. COVID has shone a light on that, and they've made the decision that I don't want to work anymore. You've equally seen quite a lot of people leave the UK, function of Brexit, but also because of the fact that they've gone to help family members through the COVID crisis. And that has definitely impacted the number of people employed within the UK. That being said, that those jobs don't go away, and that's why you are seeing record numbers of job vacancies at the moment at a time when the unemployment rate is low. And that means that you are going to start to see some wage inflation coming through. We saw wage inflation announced this week when the unemployment rate data came out, and that came through at around just over 4%. So inflation is running at 9%, 9.5%, and you've got wage inflation running at 4%, which means that we are, as a nation, feeling poorer. Our standards of living are being impacted by the fact that wages aren't increasing at the same rate as the inflation is coming through within the UK. Again, that's where we've been, and this is a chart from Bloomberg, which just puts this data into a bit different format and looks at it in different ways. So I just want to highlight a few things on this chart. The most common question we get asked at the moment is, are we heading to recession? At the moment, there's a probability of recession from Bloomberg, and this looks at different economists, of 35%. I think if you read the papers and you read the output that's produced on a daily basis and some of the headlines that come through, you'd expect that number to be maybe 65%, so maybe the other way around. And just crucially as well, I think it's also important to think about the type of recession that we could have if we do have a recession. So what is a recession? Is 2 negative quarters of economic growth. So 2 consecutive quarters of contraction within the UK economy. Now, the probability at the moment is that we won't have one, as you can see there at 35%. But if you did have one, it's also likely to be quite shallow. And if you look at remember the inflation figures we highlighted earlier and how quickly it's expected that inflation will drop off, then it suggests that inflation is not going to be an issue as we move into next year, and people won't be talking about it as much, which means the probability of recession as we move forward in 2023 actually starts to reduce. That being said, it is weighing on economic growth, and you can see here within the expected economic growth that we've highlighted how strong expectations are for this year at 3.5%, but economic growth is expected to be below average in 2023 because of that. So we're expecting a 1% growth next year when, as I said, you'd expect the UK economy to grow by by closer to 2% in an average year. So economic growth is going to be impacted. And we did see this in the past as well. So when we came out of the financial crisis in 2008, 2009, we had a double dip recession in 2011 as well. And back then it was been triggered by the European debt crisis and what was going on with Greece and the contagion impact that was spreading throughout Europe. And fast forward the clock to 2022, we came out of recession last year, and 2 years afterwards, there's a risk that we might be going into recession. And again, it's been triggered by events just going outside of Europe. So history doesn't repeat itself, but it often does rhyme. And we've been looking at the impact that this has had on markets in 2011. And it has been a very challenging 6 months, but markets have behaved exactly in line with where they were in 2011. So the point being that a lot of the news that we've seen this year has already been priced into markets. And then we've already highlighted how inflation is expected to fall away within the UK, and then this just highlights it again. So what have markets done so far this year? We're going to start with the bond market. I think there's always a tendency from people in our industry just to concentrate on what's going on in the equity market. It's been a very, very difficult period for bond markets. So bond markets, you get a fixed coupon. So it's almost like having a bank account saying you're going to get 1% a year. And when inflation's higher and interest rates move up, those numbers, that return that you expect from a bond, just higher, and that means that the prices on bonds falls. They have an inverse relationship, and that's exactly what you've seen this year. And on this chart, you've got the blue line, which is government bonds in the UK, gilts, which have fallen by just under 15% this year. It's been one of the worst years on record for a government bond. I think the point to highlight here as well is that government bonds are meant to be safe haven assets. They're meant to be gilt-free securities, which highlights that, well, maybe that's not the case if you've lost 15% of your money this year. Now, if you wanted to take a little bit more risk and you buy a corporate bond in the UK, that's that kind of maroon line there, you can see that the two very much move in tandem, are very closely related, and they've fallen by roughly 15%. If you wanted to go and buy a bond fund that's got slightly more flexibility, that's that yellow line, which is the strategic bond sector. And equally, if you want to take a little bit more risk, you can buy the green line, which is emerging markets. So you can buy debt from different emerging markets as well. And you can see that that's been impacted this year as well. So it's been a very challenging year for bond markets, with nearly every bond market across the globe being impacted by the same factors of inflation being higher and interest rates moving up. Now, from a Luna perspective, I just want to provide some comfort. We, as I said, when we were coming into this year, we expected inflation to come through and be higher, and that central banks would have to increase interest rates. We haven't foreseen the fact that inflation has moved to the levels it would have done. I don't think anyone did that, because no one was expecting Russia to invade the Ukraine when it did, and the subsequent impact that that's had. That being said, we have been at the lower end of our range within fixed income. And for us, that's really helped performance this year. And we've noticed that some of our competitors haven't done that. And the falls that you've seen in the bond market have been bigger than the falls that you've seen in the equity market. And for more cautious or conservative portfolios, you would expect to have a bigger allocation to bonds than you would equities, because you're looking for more defensive assets. And on the flip side, in a higher risk portfolio, you have more exposure to stock markets and risky investments. The point of telling you that is that you've actually seen, in some cases, bigger losses in a cautious or low risk portfolio this year than you have in a higher risk portfolio, because of the fact of the weakness in the bond market. So it's just something to be very mindful of. Fortunately for Luna clients, we have been relatively well positioned away from that, and we've been going to alternatives which have provided some more stability to portfolio returns in what has been a very challenging backdrop. Now, moving away from the bond market and just touching on global equity markets, these returns are in sterling as well. So sterling has been weak this year. So some of the returns here are slightly higher from a UK investor perspective, and I'll explain a little bit more on that in a second. Now, the worst performing stock market here has been Europe, which is the green line at the bottom there, which is down 15% or so. And that's a function of the fact that if you are going to see a recession, then it's more likely to be in Europe because of the proximity and the reliance on energy from Russia. On the flip side, the best performing stock market has actually been the Hang Seng, which is that light blue line. Now, it's been like a heart monitor, that line. Now, if you go, it's been the worst performing in the middle of March to the best performing at the end of June. And that's a reflection of the fact that, as I said earlier, that markets are forward looking. If you thought that China have had restrictions in place for most of this period, then you'd be surprised to see that the Hang Seng is the best performer. But markets look through that. When we have restrictions in place, investors are looking through that to, well, when is the economy reopening? And that's exactly what's happened in May and June within the Hang Seng, that it's bounced back strongly as the expectations are that restrictions in China are lifted, which means that economic growth is better within China, which is a positive for company earnings. Outside of China and Europe, it's been a difficult year to be a US investor, with a negative return of over 10%. If you'd been invested in just the US market and you're based in the US, that return is bigger. So the US stock market is actually in a bear market at the moment, which is a fall of 20%. And that just highlights how weak sterling has been, that it's helped to support some of the returns from a US investor perspective, and you haven't lost as much being a UK investor into the US. But it's been a very challenging period for the US, and that's been predominantly driven by the events within the technology sector and the Apples and the Amazons and Facebooks of this world, which have had a mixture of bad news this year. And that's been also based on the expectations where we were when we came into this year. If you go back to late 2021, the technology sector could do no wrong. It saved COVID, and valuations were quite high. A lot of that news has come off very quickly this year, and that's been one of the predominant reasons why the US market has been weaker. On the flip side, a benchmark, a market index which has very little in technology, but has a lot in oil and gas companies, which has a lot in mining companies, and has a lot in banks, which all have done a lot better this year as commodity prices have moved higher and interest rates have moved higher, is the FTSE 100. And you can see that yellow line there, that the FTSE has still lost money this year on a total return basis. It's down by about 1%. But the UK has been one of the best performing stock markets this year. And it's for those reasons that I mentioned. It's the sectors that it does own, as in oil. BP and Shell are big constituents. With the oil price moving up higher, that just increases the profitability of those companies, and hence why you're seeing windfall taxes applied to those businesses. But it's not just oil, it's also miners and banks which have also performed well. You can see there, though, that it was a more challenging month in June for the UK stock market, and the UK market fell around 5%, as did other markets, though, in fairness as well. So the FTSE 100 has had a better year, and I suppose taking it back to a Luna perspective, we do tend to have a bit more in the UK at the moment because we felt that valuations within the UK have been cheaper than other global markets. Now, just to take this one step further, I think there's a tendency just to think that everything is good within the UK, and it's certainly not been the case. The FTSE 100 is different in that the amount it has in oil and miners and banks. Those three sectors are not well represented as you move further down into mid and small type businesses within the UK. So this chart just highlights how different markets within the UK have done. So we've already seen the yellow line, which is the FTSE 100. That's world equities, just to put in context. But small cap are down 15%. Mid cap companies, so the FTSE 250 is down around 20%. And if you've invested in AIM, which is smaller companies quoted in the UK, you can see that the falls have been quite significant. And the rationale for that is that if inflation is a bigger concern and economic growth is impacted, and then it's going to have a bigger impact into more mid and small cap businesses, which are more reliant on the economic cycle. And those businesses have been particularly impacted this year through the events of weaker economic growth and the fact of higher inflation. Now, one of the questions we get commonly is, why has the FTSE done so well? Why haven't we had more in the FTSE? And I just wanted to highlight this chart, which just shows the importance of diversification. And we invest in all of these markets at Luna. We invest in the US, we invest in Japan, Europe, Asia, UK. The amount we have in each of those markets changes over time, depending on our forward-looking prospects of those countries and those stock markets. So the UK has, over 10 years, delivered a return of 88%, which is a relatively decent return. It's about 6 or 7% compounded on an annual basis to get to that return. On the flip side, the story of the last 10 years has really been about technology. And you can see there that the S&P 500 has delivered a return of over 300% over the same time period. The earnings and the margins that these big technology companies have delivered and grown at has been spectacular. It's been not seen before in terms of how quickly these businesses, despite their size, can continue to grow and continue to take market share. On the flip side, you've got the Hang Seng, which is just about doubled your money over this time period as well. Now, different markets will all perform at different times, and that's why we blend them together, because we're looking to smooth out the returns across different equity markets to deliver a well-diversified portfolio for yourselves. Now, just taking a step back, it has been a challenging year for investment markets. We've already highlighted that within the bond and what global equity markets have done. And this chart just shows what has happened in the past. So this goes back to 1986. I'm going to touch on the red dots first. The red dots highlight the worst possible drawdown in the year. And the grey bars show what the year ended at, what was the total return for that year. And you can see, firstly, let's just touch on a few years that stand out. The worst year was the financial crisis in 2008. The FTSE All Share, fell 33% in that year. At its worst possible point, though, it was down at 43%. And just fast forward into what we've seen this year, and it's important to remember, as I said, that the FTSE and UK markets have done better. But you can see that the worst possible point, that the FTSE All Share was down 10, and we're currently down -6% at the end of June. Markets have improved dramatically in July already, which is interesting because we're still getting bad news coming through. Now, the purpose of showing this is the red dots happen almost every year, and the average fall is 15% in an average year. But on average, markets still deliver positive returns, and they've done that in 25 of 36 years. So you do get drawdowns in years, and 15% is very common. So I appreciate this feels incredibly uncomfortable, the environment that we're in, because equities and bonds are falling at the same time. Point of highlighting this is very common within markets, and we have been used to this period of volatility in 2018 when we had the China-US trade war. In 2020, we had COVID, and this year when we've got higher inflation. But even if you go back over through the years, we've also lived through a financial crisis and a technology bubble as well. So over the last 20, 30 years, we have seen periods where markets have been volatile. And in all of those situations, it's turned out to be a good buying opportunity when you see these big drawdowns, because the market has historically recovered afterwards. Now, this chart goes back and looks at the S&P 500, and we've selected the S&P 500 because it's got more data than other stock markets, and it goes all the way back to the 1930s. This shows the first 6 months of the year, and when the US stock market has fallen by more than 20%, which is technically a bear market. And 2022 was the 6th occasion on history when the US stock market had fallen by more than 20% in the first 6 months of the year. The first was in 1932 in the Great Depression, but you can see here that the last time that happened was 52 years ago in the 1970s. So the blue bar represents the fall that we've seen, and as I said, it's been clearly a very challenging period to be invested in the US. But what the gold bar or the yellowish bar represents is what happened from July to December for those years. And as you tend to see, the more markets fall, the quicker and more sharply they bounce back. So in 1932, it was the best year, best second half of the year to be invested after what was an utterly horrendous first half of the year when the market fell by nearly 50%. Now, it's interesting that every single one of these occasions in the past has been delivered by a positive return. And I suppose there's probably a few reasons for that. And I don't know the details of what was happening in each and one of these years, but it's a function of what would have been happening is the fact that markets are forward-looking, as I mentioned, and move in anticipation of events. Stock markets have already moved lower to reflect the fact that inflation is higher and the impact that can have on a consumer and the impact that's going to have on economic growth within global nations. So you've already seen stock markets adjust lower to reflect the future economic environment. So if things are slightly better and there's a lot of bad news which has already been priced into markets, which is something that we certainly think is the case, then it's very possible that you see a bounce back in the second half of the year. And you can see the historic bounce back that have come through have been probably on average around 15%, just excluding 1932 because it was such a strong year. But an average bounce back in the second half of the year would be around 15%, which is quite a strong return. And back to something that was highlighted right at the beginning of the call, some of the worst decisions we can make now is potentially to be disinvesting to reflect what has happened. It's important to look forward about what can happen. Now, just going to highlight a couple more charts before we round up. This chart also looks at the US. This chart looks at the US election cycle. Again, it's concentrated on the S&P 500, the main US stock market, and it shows the quarterly returns shown from 1950. Now, it's not really being talked about at the moment, but and it probably won't be until the end of the summer, but we are just tipping into this point. We're moving into midterm elections in November, and midterm elections tend to be a very positive period for the US stock market. The reasons for that is president gets elected very early on, looks to make as much changes as possible very early on in their candidacy, realizes they can't get enough done, disappoints in terms of expectations. Midterms tend to be bad. You tend to then see them lose a little bit of power, which is a positive for the market, because the market then sees, well, there's less chances of more political changes which can impact companies and company profitability in the next 2 years. And that's why you tend to see markets perform better. So we don't know if we've hit a low within the market. The middle of June at the moment looks like a very short-term date when stock markets do appear to hit a more short-term low. But if we start to look forward a few months, and you don't have to look that far to the fourth quarter, then this tends to be a very good seasonally adjusted period to be invested in the S&P 500. And the S&P 500 is very correlated to what's going on with other global markets. It's not going to be acting independently. So historically, this has been a good period to be invested. Now, I think the other point that we've highlighted, we focused on very much on the short term so far. We've focused in on what's happened just this year. And I was speaking to a client recently, and we were talking about the financial crisis back in 2008. Now, that was a horrendous environment to work through. You had banks being bust, you had unemployment soaring, it was contagion in the bond market, you had liquidity issues. It was horrific. And the fall in markets was quite severe. We fell 41% in that period in just over a year's time. I suppose when I look back now at what the impact of that market is, you can see it looks pretty small on this chart, because subsequently you've had a 226% increase in the FTSE all share since then. So when you reflect back on situations now to 15 years or so ago, it looked like a small speed bump on the road. And when we reflect on this higher inflationary impact, maybe in 10 or 15 years time, or we reflect back on COVID in 8 to 10 years time, it's going to look like a small speed bump on the road again. And that's because of the power of compounding and the power of long-term drivers of returns. And that's really important to concentrate on periods like this. As I said, we appreciate it feels very uncomfortable, this environment, but we are not investing for 3 or 6 months. We're investing for a long period of time. And the average bull market lasts 6 years. Now, this bull market started in March 2020, so we're just over 2 years into this bull market. So I'm not, if history was anything to be judged by, we've got maybe another 3.5, 4 years of this to have an average bull market. And some of the returns that you can generate in a bull market are extremely high, as you can see on these charts. So just to summarize, the political developments in the UK have had very minimal impacts in terms of markets. Only really sterling has been impacted this year, and that's been a slight positive, if anything, to the FTSE 100 because of the overseas earnings that come through. It's been incredibly frustrating and challenging period to be invested, with equities and bonds falling. We haven't not seen a company warn on profitability yet. Company share prices have been falling on the expectation that comes through in the second half of the year, but we haven't seen that yet. So we're still seeing companies report very good numbers, but seeing their share prices lower. It feels a very weird environment. The volatility continues to be driven by those three factors: inflation, interest rates, Ukraine and China's COVID strategy. If we're thinking about this globally, I think inflation is going to start to become less and less of an issue over the next 12 months or so, and it's probably even shorter within the US and Europe. China's COVID strategy is starting to change, and economic growth in China is expected to accelerate. So two of the main headwinds that we've had this year are starting to move into the rearview mirror. And look, I think we all hope that there's a quick resolution with what's going on in Ukraine, because it's clearly a terrible humanitarian crisis that we're going through there. From an investor perspective, it's a known situation now. Markets don't like uncertainty. So the only way that this is going to continue to impact markets going forward is if things escalate from here, which I don't know, who knows, but I think is unlikely at the moment. We haven't touched on investor sentiment, but that is very low. We look at the bear and bull chart, and that highlights that there are a lot more bear market investors at the moment. People are very cautious about the environment, which reflects the fact that equity markets are lower. So the point of highlighting that is, so where's the next seller going to be if everyone's already quite bearishly positioned? And it's always the next seller or the next buyer which drives equity markets in the short to medium term. It's difficult going through periods like this, but as we highlighted with that FTSE All-Share chart, market corrections are very common on an annual basis, and markets tend to deliver positive returns more often than the negative returns. And as we've highlighted a few times, just think longer term. Let's not focus too much on the short term, because markets do recover and do bounce back very strongly after periods of higher volatility. And if we fast forward the clock to 2 or 3 years, when we're looking back to this environment, it's a strong chance that we'll be looking back with inflation being lower. Hopefully the war's over, and here's hoping that COVID is something that we stop talking about. It's definitely something we stopped talking about within the UK. So it's for China's vaccine program to kick on. So that's something that we don't talk about there as well.